Welcome back to Learn SKN, and today we're going to finish up that January 2018 paper 2, the January 2018 paper 2 for principles of business. So we're up to question 5. We would have covered question 1, 2, 3, and 4 in previous videos, and now we have question 5, which is the last question for this paper, and so we're going to jump right into that. So question 5 for the January 2018 principles of business paper 2 asks, define each of the following terms: economic growth and economic development, and both of them are 2 marks for a total of 4 marks. And so we jump over to our textbook. Economic growth is usually measured as the increase in the value of production of goods and services in a country over the period of 1 year when compared with a previous year. So in essence, this is what we're talking about GDP. You know, I'm talking about GDP when you're looking at economic growth. So it could be said that economic growth is an increase in the GDP of a country. You know, GDP is the monetary value of all goods produced within the country. So you can say GDP is a change in GDP, an increase in GDP could be considered as economic growth. So the definition is usually measured as the increase in the value of production of goods and services in a country over the period of 1 year when compared with previous years. Traditionally, it is measured as an increase in the value of output, GDP, or an increase in the value of national output, GNP. Right? So that's economic growth, the definition for economic growth. Right? All right, good. Then the second one asks for economic development. And so the definition here, economic development is when an economy improves its standard of living and quality of life by improving both the economic and social conditions of its citizens. So again, economic development is when an economy improves its standard of living and quality of life by improving both the economic and social conditions of its citizens. So we're talking about development is more qualitative, so there's a change in the quality of life, and that's normally reflected in improvement in economic and social conditions. So all of a sudden you can afford more things, you have better health care, better education, all kind of thing, right? So that's the definition for economic development, where there is an improvement in the standard of living and the quality of life in the economy. Then question 5b asks for 3 marks. List the 3 methods by which governments measure the national income of a country. So how do you measure the national income of a country? And so the 3 methods would be the income method, the expenditure method, and the output method. And so you have the income method, methods of estimating national income. You have the income method, or add together all the factor income such as wages and profits. Then you have the output method, add together the market prices of all final or finished goods and services, that's the output method. And then you have the expenditure method, where you add together the total amount spent, expenditure, on all final goods and services. So those are the 3 methods of calculating national income, GDP, within an economy. Those are the 3 methods, right? So the income, output, and the expenditure. And all of them should equate to the same thing, because of course your income for somebody would be the expenditure for somebody else, and the things that you buy with that money could be the output for somebody else. So all of them should equate. And then we have C, state 3 reasons why countries engage in international trade. So why do countries engage in international trade? And this one's a little self-explanatory. And by self-explanatory, what I really mean is that it's a very commonsensical one. You know why certain Caribbean countries have to trade with the US or EU or wherever? Because 1, resources. Countries have different resource endowments. Some Caribbean countries such as Barbados and Cuba and Trinidad and Tobago have crude oil reserves as a natural resource. As such, these countries have developed petroleum industries and export petroleum and petroleum-related products. Other countries lack crude oil, and so therefore they have to trade with another country to get those things. Even if we're talking about stuff like gold, bauxite, aluminum, those natural resources, some countries have it in abundance, some don't, and so therefore you have to trade for those things. Same way, you know, some countries can grow certain crops, certain vegetables, but others can't. And so those who can't will have to trade with those who can if you want to be able to get those kind of resources. Right? So resources. Then you have goods and services. Again, similar to what I just said, every country cannot produce everything that they need. Some countries are better at producing certain things, certain goods, certain services. Some countries are known for financial sector. You have your Swiss bank account and all those things. Some countries have different goods. And so the goods that you cannot get in your country, you have to trade for them, the goods and services. If a country does not produce the quantity or quality of goods and services it needs to import them. For example, some hotels import fresh produce even though local production is available because they want the quantity and quality required, reliably and when needed. So this one is very obvious, very self-explanatory again. You trade for goods and services that your country cannot produce at a level that can sustain that country. So you have to trade for that, those kind of goods or services. Or you trade for things that just don't grow or just not produce in your country. And of course, you take part in international trade for capital. International trade allows for individuals to invest money in foreign businesses in other countries. This foreign direct investment may be in the form of financial capital, money or shares, and physical capital, buildings, machinery, etc. And so in the Caribbean, we know that a lot of foreign countries, a lot of Americans, Europeans, Middle Easterns, Chinese, especially the Chinese, they come into different countries, our countries, and they invest heavily in a number of things, in infrastructure, in supermarkets, a whole lot of things. So that's one other reason why they would engage in international trade. So those are three reasons why countries would engage in international trade. So right here on the slides, I've explained a bit more. So the Caribbean need to import food. So the reason why they would import food which cannot be grown, as we said earlier, minerals which are not found here, as we said earlier, goods which require greater economies of scale, which means that some of our countries are just too small, and so we cannot produce certain goods on a certain level for it to be competitive or cost effective. So you have to import those things. And then goods which are produced elsewhere at lower cost or higher quality. So those are reasons why we might import. And then reasons why we export, so the other is going to buy it from us. Traditional agricultural good exports such as coffee, nutmeg, and sugar. From our days of slavery, we were basically the food basket in a sense for Europe and places like that. We would export, the sugars and those kind of things because our tropical climate allows for those things to be able to be grown here. Then you have forest and fishery products, mineral produce such as bauxite, gold, or oil, processed goods from mineral products such as methanol or cement, some other manufacturing goods. So those are other things we will export. So all those are reasons why we engage in international trade. It benefits everybody in the long run. So you use any of those answers. This says state. So you use any of those answers, and you should be able to get your full 3 marks. Number 5D. Distinguish between balance of trade and balance of payments. Distinguish between balance of trade and balance of payments. And so we see here that the balance of trade can be defined as the difference between the value of a country's exports and the value of a country's imports for a given period. Balance of trade can be defined as the value of a country's exports and the value of a country's imports for a given period of time. Whereas the balance of payments now would be the balance of payments is a statement of all transactions made between entities in one country and the rest of the world over a defined period of time, such as a quarter or a year. So the balance of payments is a statement of all transactions made between that country and all the business that the country did with other countries in the rest of the world. So that's the balance of payments. Whereas the balance of trade is the value. So it's the import versus export. So it's the value of the country's imports versus its exports. So if you have like an adverse, if you have more imports than you have exports, then you'd have a balance of trade deficit. But if you have more exports than imports, you have a balance of trade surplus. So balance of trade is all about the imports versus the exports is the difference between the value of a country's exports and the value of a country's imports for a period of time. Whereas the balance of payments is all the receipts, all the transaction that a country goes through with other countries in the rest of the world. So those are the key differences between those two concepts. So if we go back to the economics textbook, it also gives us a little explanation for them. So in the textbook, you have the balance of payments is a summary of the payments and receipts of transaction between a country and the rest of the world for a given period of time, usually a year. So that's what I said earlier. So it's a summary of the payments and receipts. So how much you pay and how much you receive. You pay out the cash flow, your cash outflow, and the cash inflow for transactions between a country and the rest of the world for a given period of time. Whereas the balance of trade now, again, like I said, is about the difference between the imports and the exports that a country has with certain trading partners. So the balance of goods and services account combined is called a balance of trade. So the balance of goods and services, so how much goods and services you import versus what you export, that is called the balance of trade. And of course, it can be positive, negative, or doesn't change. It could be equal. Right? So that's how we distinguish between the balance of trade and the balance of payment. The very definitions is a distinguishing characteristic just by the definitions alone. So you define both of them, then you can get the differences right there. Okay, good. So the last one for question 5, the 6 marker, explain 2 measures a country may adopt to address its balance of payment problems. So in a country, like in most Caribbean countries, we have balance of trade, balance of payments deficits. Then we need to address those problems. A lot of the Caribbean countries are in debt, and so therefore they have a deficit for the balance of payments. Now, how do you address these issues? Of course, one of the ways is to borrow money. You have places like the IMF, the World Bank. In times when your balance of payments have issues, you can go to those institutions and you can borrow some money and you can try to stabilize, recalibrate your balance of payments. Other solutions is, of course, developing exports of goods and services in the best long-term solution. So the saying here is that to improve your balance of payments. Remember, balance of payments is all about import versus export. So we're saying here that the country has problems when their imports are greater than their exports. So that means they're spending more money than they're earning in international trade. And so one way to solve that problem is to develop certain sector, the industrial sector, the manufacturing sector, develop certain sectors so that you can export more. So you have to increase exporting in order to correct the balance of payment deficit. So that's one way in which they can solve that. The Caribbean countries can solve that, develop various industries so you can improve overall export, whether it is your manufacturing industry, agriculture industry, whatever, the financial service industry, just so that you can improve the exports of certain goods or services. Then, of course, local and foreign investment assists this goal. So local and foreign investment, you can, as a government, you can invest locally in certain, like I said before, in certain industries so that they can be boosted. Or you can invest, you can allow what you call foreign direct investment. Governments can encourage new investments. Again, we're talking about both local and international. So you can use certain foreign companies to invest in our economy, and so that money can be turned around and used to help to enhance our capacity in the Caribbean. And so that can help to correct the balance of trade problems that might arise in our economies. Investment may be in tourism, mining, manufacturing, agriculture, or other export industries. So that's what we were saying earlier. Other possible solutions: currency devaluation makes imports more expensive and exports more competitive. So let's break down this one here. So if you want to correct, if you're in dire need, extremely dire need, and you want to really correct the balance of payment issues, in quick order, you can devalue your currency, and that makes more imports more expensive, meaning for example, Jamaica, Trinidad, you'd realize that their currency would be of, let's say, a lower value than, let's say, the EC dollar. And so if Jamaica and Trinidad want to be competitive, and Guyana also, competitive on the export scene, then they would lower the value of their money, which means now that persons outside don't have to spend as much as their money to get Guyana and Jamaican and Trinidadian currencies. So now you realize the US, it would be for 1 US, you'll get a lot more of that local currency than you would have before. And so that would encourage persons who are in the US to invest more in the countries that has a lower valued currency. So you'll see a lot of people like you have the US dollar, and so therefore your dollar can stretch way further, and so you're more willing to invest there. You're more willing to buy stuff from there because it's relatively cheaper than if the currency was a lot more higher value. So yeah, so the currency devaluation makes imports more expensive, meaning again that local persons, people on the ground in Trinidad, Jamaica, wherever, Guyana, they would not be as keen to import goods, so they'll buy more local. So that way you can curb imports. So you can curb imports that way, because you'll have to spend more of the local currency just to get $1 US or £1. So that will make it a little too expensive for the local population, and so that will curb imports. And if you curb imports and increase your exports, of course, that's what you need. You'll get a surplus you're supposed to get a surplus in the balance of trade. So that's why devaluing your currency can help in that way. And of course, as we were discussing earlier, you can get overseas loans and grants from different institutions like World Bank, IMF. And of course, some extreme measures that you can take is of putting in certain trade barriers to restrict trade altogether. So you can use things like import licenses, quotas, rationing of foreign exchange, and things like that. Some countries still use rationing of foreign exchange, meaning that individuals cannot just go and buy any amount of US as they like or any amount of pounds as they like. The government still controls how much individuals can get. So that can be used to curb the amount of foreign currency that's flowing outside of the country for importing stuff and things like that. And of course, you can also use quotas, meaning you only allow a certain level of imports of certain items within your country, and that can cut down the imports and carry up the exports to try and correct the balance of trade deficit issues. Also, of course, import licenses, where you have to make sure to limit the amount of license you distribute to persons so that you can bring down the level of imports and try to take up the level of exports in order to correct the balance of trade, balance of payment issues. So all those are things that you can use, the government can use in order to correct a balance of payment problem. And so all you have to do now is choose any two and you explain them, and you should get your full marks. So you can choose any two. You can choose foreign direct investment, you can choose devaluation of the currency, you can choose trade barriers, you can choose investing in industries to increase exportation, you can choose rationing of foreign currencies. You can choose any of those, explain them, and you will get your full marks. All right, so that is it for the January 2018. That is it for this paper. Right, that is it for this paper, the January 2018 paper 2. That is it. That's number 5. If you follow all of those videos I did before, you'll be sure to get your full marks for that one and totally mash up this paper here. Wasn't too hard. You can see where I got the information from in the textbooks, so you can use them and you'll be able to pass this exam no problem at all. All right, so that's it for now from Learn SKN as it relates to this paper. The next paper we're going to drop would either be paper 3 for 2018 or the June, July, August paper 1, the multiple choice from last exam cycle. So you want to know which video drops next and Learn SKN is of course to subscribe, hit the notification bell so you know when Learn SKN drops another video, and of course do me the huge favor, like the video please. Like it, smash the like button and share with your friends, your loved ones, your cousins, your uncles, your aunts. Share with everybody. Let's get the channel to 10,000 just now. Alright, let's get to 10,000 subscribers. Let's get it growing. Let's get it happening. Alright, so we have some other videos in the works, but you only have to, outside of past papers and lectures, there's some other videos in the works. So you know what to do again. Subscribe to the channel so you know when the different videos drop. Alright, so that's it for now. Thanks for watching. Thanks for listening.